And welcome back to yet another exciting week of the Lazy Money Game. In this week's episode, I'm going to talk about inflation and in particularly which investments tends to do better if you are seeing an increase of the inflation. And of course, it is very natural to talk about this since we are hearing so many stories in the news regarding an increase of the inflation. And afterwards, I will of course give an update to my portfolio as well. So if we start by addressing the question, how to invest your money during a high inflation period. If we start from the bottom with the worst investment you can do and then gradually go up through the list and then at the end up with what in a theoretical sense is considered to be the best possible investment you can do during a high inflation period. So the worst thing you can own during a high period of inflation is actually cash, because cash will lose a lot in value when you have high inflation. If the inflation is 10%, that means that your real purchasing power will go down by 10% every single year if you're holding cash. We can of course have a discussion about whether or not we think that cash is actually an investment. But since cash gives you the opportunity to do investments, I actually believe that they belong on this list. And they are at the very bottom because they will lose the most in value. So if we don't want to hold cash, what is just slightly better than cash during a high time of inflation? Then I would argue that it is non-productive assets. That could be something like gold or art. An asset that is not producing anything, but at least it is supposed to be able to keep its value. However, as it is with gold prices, they fluctuate, and art, well, what is now the latest trend, then you will have those kinds of volatilities there. But at least in theory, they are supposed to keep their value, hence they are slightly better than cash. And if we actually go one step deeper with this art as a form of investment, well, if you are trying to make an investment in art, then you are not trying to predict how your own taste will be. You're trying to predict how other people's taste will be. And as we all know, taste really depends on the people we are asking, and it is really subjective. So it's quite hard to predict what other people would like in 5 or 10 or 20 years from now, or however long a high period of inflation would last, if you are making an investment in art and try to be successful at it. So if we then move an additional step up, then we have productive assets with a high capital cost. So now we are not just trying to preserve our capital, we are actually trying to see if we can get a return. And if we are investing in stocks, which we are doing when we are investing in productive assets, because this is companies, then they are number 3 on this list if they have a high capital cost. Because if inflation is rising, then it is more costly for them to run their business, hence they don't deserve a spot which is better than number 3, and this should hopefully become more clear as we move up the list. If we then move one step further up, then I would say that rental properties and farmland is better than productive assets with a high capital cost. This is due to the fact that you have more control of the price which you are charging if you have rental properties and farmland, and if your capital cost is lower, that puts you in a better position to actually negotiate about the prices. Hence, you should be able to get better returns since you can pass on some of your costs to your customers. So if we go to the number 1 spot on the list, that would be productive assets with a low capital cost and a high return of investments. And the reason why they are number 1 is they have the negotiation power, meaning that they are capable of increasing the prices and passing on a lot to the consumers so they can still earn a lot. And if they are doing any investments, then they are getting a high return on those, meaning that it will still be a good business to be invested in. And what are some good examples here? Think about something like a software company. If the consumer is to choose a different software service than the one that you have provided them with, then they will have a lot of costs associated with it. For instance, if all your employees are used to using Microsoft, if they then would have to switch to Apple, that would take a lot of time for them to learn how to navigate and how to use the different functionalities. That means that Microsoft, for instance, would be capable of increasing the price for their services and simply pass on the higher cost to the consumer without losing too much sales. Of course, there are some pain points. At some point, you will start as a consumer to go with a different service provider, but at least you have more pricing power or more negotiation power in this case. You could of course also take an example of well-known brands such as Starbucks or Coca-Cola, where people are willing to pay a higher price, and even if the price are increasing just slightly, they will still pay that just to get what they know, no matter where they are. So of course there are these pain points where the consumers will start to change their behavior if the price increases too much, but at least they are starting out with a much better point in their negotiations compared to companies which have a high capital cost, simply because they would go out of business if they increase their prices too much. And just to be clear here, these are not my ideas. These actually come from Warren Buffett. If you listen to the different annual shareholder meetings over the last 25 years or more, you would actually be able to pick out these and make this list. So I just saved you the time by summarizing this. And I mean, if you look to number one here and look to Warren Buffett's portfolio, take the biggest position in his portfolio, namely Apple, which makes up around 40%. I mean, that is really a well-established brand. They have a high return on investments. They are capable of rising their prices because the consumers absolutely love the product which they are making. And they have the economics of scale, meaning that they can make more of their products without having to increase their capital cost too much. But whether or not Apple is a good investment today is of course a completely different matter, which I'm not going to touch upon. And if you know Warren Buffett well, then you would of course say there's missing one thing on this list, because you need to remember, as always, the best investment you can do is an investment in yourself. And that actually still holds true no matter if you are in a high inflation scenario or a low inflation scenario. Because if you are the best at what you are doing, then you have a much better position to negotiate about prices. Imagine that you are the best doctor in town. Well, then you can definitely increase your prices without losing too many customers. And one disclaimer that I have to put in here is, of course, never invest more cash than you are comfortable with. This is just to illustrate what will actually happen and what will be the best investment during a high inflation scenario. So the cost of keeping cash goes up if the inflation goes up. But I will still always have my emergency fund, and if you know that you're going to buy a car or a house within 3 years from now or something like that, then I will of course have more cash, since the worst thing I can do with an investment is put myself in a position where I am forced to sell. I am willing to pay negative interest rates to avoid a situation where I'm forced to sell, because that will most likely be much more costly for me. If we then turn to my portfolio and see what has happened within this week, well, the first thing we notice is that there's a green circle for this week's episode, meaning that the portfolio has increased in value compared to last week. So we go to the portfolio overview tab here, and then we can see that the portfolio has increased $100 in value compared to last week. And at the same time, we can see that the cost has stayed the same, meaning that I have not done any new purchases. If we then continue to my favorites tab, namely the dividends tab, then we can see that it has been truly an exciting week for me, since I have surpassed my previous record of $405 within a single month, since I have now received $488, and within this week I have received $120 from Unum Group, so I am naturally truly excited to share this great news with you. So this is actually what motivates me a lot. I mean, $488, that is actually real money for me. This is something that can truly start to pay a lot of my bills. And the good news actually doesn't even stop there, because I received this email notification that Unum Group has raised their dividends by 5.3% from the third quarter on, meaning they are going to pay 30 cents per share instead of 28.5 cents per share. So if we go back to the portfolio overview, just to illustrate the point here, and have a closer look at Unum Group, let me just zoom in a bit here, just to make it even more clear. Then we can see that we have this dividends of 28.5 cents per share. If I then update that to 30 cents per share, then you can see that my next payment has increased with $7.50 every single quarter without me having to work for it. So this is what dividend growth investing is actually all about. So that actually sums it up for yet another exciting week of the Lazy Money Game. So now you know more about where to invest your money when we are seeing higher inflations, and if we are to trust anything from remedies these days, then we should definitely prepare ourselves for higher inflation. So if you like content like this, then please consider leaving a like, comment on the video, or subscribing to the channel. It really helps me out a lot. And until I see you next Sunday, bye!